Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. All right. Let's look at the SPX. Let's look at doing a trade in the SPX. The market's opened up a little bit today, and they're starting to give back. It's interesting to note that if we go all the way back to April, we're almost all the way back to those levels. Feel like the market's getting a little bit overbought at this point in time. We have some. I think earnings has helped a little bit here. The fact that we're in the heart of the earnings season, we got a lot of the Meg 7 that we'll be announcing this week. We have Microsoft, we have Meta, we have Amazon, we have Apple. We have all these companies that are announcing. So it's going to be an interesting week overall. I want to ride this into Wednesday, though, on our SPX trade. I don't want to get to the end of the week here. I think Apple is going to be the most interesting one to hear the comments afterwards. Obviously, the stock has rallied, but there's no real reason for the stock to be rallying. And I kind of wonder what's behind that. Apple has a tendency to sell off after their earnings report and might get short on Apple going into that trade. They still have a fairly high valuation and they have a lot of issues. 80% of the iPhone is made in China, and there is no, at this point in time, it does not look like there's any resolve for it. We do have a statement saying that the mobile phones are going to be excluded from the tariffs, but there's still a lot of pending issues there with Apple. So buy the rumor, sell the news type scenario. I think that that's going to be the most looked at position, but I still feel a little bearish in the market, and we still got the VIX hanging around. As a matter of fact, we see the VIX up a little bit today, and it was up a little bit on the open, even though we were up in the S&P 500 index. Right now, we're down 1 point, or basically flat in the S&P 500 index. So we looked at a trade on Friday for the SPX, our little butterfly that we like to do. I want to look at doing one with the Wednesday expiration. So at this point in time, with the SPX at 5,523, we tried to put one together on Friday and we couldn't. We had technical issues, to be blunt. So let's take the fact that the market hasn't moved. Well, the market was up Friday going into the close, but the market hasn't moved today. And let's get a little bit bearish going into the end of the week. Now, that's when all the major companies are going to be announcing earnings. And here's the thing is that the VIX is hanging around 25. With the VIX elevated, butterflies are cheap. Implied volatility high means you're selling two option contracts inside a butterfly for a 1x2x1 butterfly, a standard butterfly. We're going to open a wing, allowing us to get bearish on it. We would make the adjustment on Tuesday heading into Wednesday. Now, if the VIX was lower, we'd look at maybe doing a Thursday or a Friday expiration. S&P 500 index is a very interesting underlying in that it has an expiration every single day of the week. So you can pick whichever one that you want to choose, whichever one you want to trade. So with this scenario here, we're going to get bearish in the SPX. We're going to use the Wednesday expiration. That would give us 1 day to adjust if the market did bounce back today. We could make an adjustment at the end of the day, and I'll go through that adjustment. And then we're going to look at a trade in PayPal. They're going to be announcing earnings tomorrow. And then at the end of the week, we're going to look at either Microsoft, Apple. We'll decide as we get into Wednesday which underlying that we want to trade. But Microsoft announces after the close. I like to trade companies that announce on Thursdays because then you have a 1-0 DT or 1 day to expiration, or otherwise known as a 0 DTE option after the earnings report. So it only has 1 day to live. All right, so here's the trade that I had set up, and gosh, the market is now down 6, and this seems to happen every time we do the show. All of a sudden the markets start moving as soon as we get into the trade. But I had it set up, it was 240, now it's 290. All right, let's adjust it. I want to go down 5 points, but the trade's already up 60 cents since I started the show. That's crazy. Okay, cleared out. let's go down one. We're going to do, I just want to be 5 points out of the money when I start. So 55.20 is the at the money. We're going to buy the 55.15, buy one of these. We're going to go down, dang, I'm going to go down 20 points, and we're going to sell two of these. All right. And then we're going to go down 15 points, and 15 is going to be 80, and we're going to buy one of these. Tell me this is $2.40. Waiting for the quote to adjust here. 520. Now we're down 765. So once again, it seems like maybe 11 o'clock Eastern time is when news decides to hit the marketplace. That does have a tendency to happen. We're going to send it to the what if calculator. Let's see what happens if we do that. The SPX chains I've struggled with during the show from time to time, mainly because they're just such a big lift, and having everything running at the same time has that issue. All right. And now we're completely froze. There we go. Oh, shoo. All right. Didn't want to have to go through that again, the experience we had on Friday. So here we go. Here's the open wing butterfly that we're looking at doing. It says $2.80. This is, yep, this is the right one. $2 and now it's $3. I like about $2.70. And that's where I would kind of put it at. But the market is still going down. It's tanking at this point in time. In relative, it was flat, and now we're down 10. And so if we're looking at this, now we're down 13. If we're looking at, we'd have to get this trade off quick, right? So here's where the market's at, and we are buying the 55.15 strike, selling two of the 54.95 strikes. Okay, so that's 20 points wide. We're going to open a wing, and we're going to buy the 54.80, still done for a relatively decent price. I'm thinking I'm putting this in at 270. Market is really moving. I'm going to say 270, and I might even adjust again and go down it, but we're going to just leave it right here for now. And if we do this, we have the open wing. So from this point on down, the butterfly would be worth $5 at expiration. Okay. So why is it worth $5? Well, we're doing a long put spread and a short put spread that makes up our butterfly. The long put spread is the driver of the profits in the butterfly, if we're correct on our forecast. And that is 20 points wide. We open a wing. By what I mean when I say that is that we do the short spread, and that's 15 points wide. So you combine that, the difference between the two is 5 points. So if the market goes down from 54.80 on down, this thing would be worth $5. If we paid $2.70 for this trade, well, then at that point in time, we would be up $2.30 total. My ideal situation, which I had set up before the show, is we were 5 points higher, and we did the trade for $2.40. And then you have like a 50-50 scenario. If the market drops precipitously to the downside, then you have that. Now, if the market just kind of goes down and it hangs around this level, you can put this trade on for that. And actually, the maximum you could make on the trade would be, or the maximum that it could trade for would be 20 points, which is the long spread difference. But that means it would have to go out right at our short strike, right at expiration. And that's just not going to happen, right? Let's be realistic. So if we land anywhere within the wings of the butterfly, we are even better off. But if it tanks and goes all the way down, no worries. And on top of it, the SPX weekly option contracts are cash settled. So you don't even have to trade out of it if you don't want to, because all that's going to happen is cash is going to end up in your account. You're not going to get exercised and buy all 500 stocks in the S&P 500 index. It's just going to be cash settled, which is a very nice benefit of the S&P 500 index. And you can't be exercised early either. So I like the butterflies in this index for those two reasons. Is the biggest reason. I want to get bearish a little bit on the market. We've had a big run up. Like I said, we've almost going all the way back to the beginning of April. We're almost all the way back to that level. And I do think that, markets just don't go straight up and they don't go straight down. They usually have a little bit of chop to them. So I do anticipate that we'll be a little bit weak heading into the earnings. We'll get a lot of comments from companies. Visa announces tomorrow. PayPal announces tomorrow. So that will give us a little bit of insight into the consumer. We do have some economic data too that's going to be happening. So it's going to be an interesting week. The insights in the consumer from a couple of the credit card money handling things will Visa will always have comments on consumer debt and how much spending is happening. So very, very interesting week in the market. I'm going to lean a little bit bearish, and we're going to do this SPX trade. Now, I promised you that I would look at the adjustments, and I guess I'll go back and I'll look at that trade. I hope that the option chains are still working for me, and they are. Okay, so here's the trade. Here's the adjustment. Now, if the market were to go, right now we're down 7. So now this trade even looks a little better. Yep, now we're at like 280. Market is a couple of points above. If this was 55.20, just because we've done so many of these, I would expect to pay 240 for this butterfly. So if you're 5 points out of the money, see if we get there, then I would put this in, maybe it's 250. Market's not going our way, but I wouldn't mind putting this trade in just the way it is and put it in for 240 or 250 and see if we could get a fill on it. 265 I see dancing around. Need the market to come back up to around 55.20 in order for that to happen, but that's where it would be at. All right, I digress. So 55.15. So here's the adjustment. The adjustment is if the market were to run up, let's say 1% or 2% tomorrow, somewhere in that range, well, 1% about before if you can make the adjustment, then you take this underlying, you take this option contract and you sell it and you buy back one of these option contracts, and you do that for a net credit to the account. You're trying to get more than what the net debit would be, and then you just ride a short put spread, and it's just that simple. You were going to ride that out. You have more risk because you have 15 points worth of risk on the downside, but that allows you to get bullish on the marketplace fairly simple and bring a net credit into the account. So let's look at that trade. 55.15 minus plus 54.95. We're going to sell this by that. That would be the adjustment tomorrow. If the market ended up 1% or so, you'd be looking to make that adjustment if you're willing to take on the additional risk. Okay, so let's get rid of this one. Let's pull this one down to 1. And you see that is right now trading for a net credit of 540 to the account. That's the wrong one. 540. This is the 515. So this is $8.45 net. This would be a credit to the account. We would be selling the 55.15s, buying the 54.95s, $8.35 net credit. If the market moved up 50 points or more on the upside, this would be trading for maybe around $3 or $4. And if you did that, then you would be making that adjustment, paying $2.50 for the butterfly, coming back and adjusting it by doing the alternative trade here. And the alternative trade or the adjustment would be to sell the 55.15s, and I'll make that to open, and buy to close one of the 54.95s in that instance. And if we did that in that scenario, we'd be bringing in a net credit into the account. And our outlook then would be that we want the market to stay above the 54.95 level. Ideally, the way the market is going right now, we're already starting to drop in that range. We're building some downside momentum. You can tell by a little bit of the chop. So right now you're looking okay on the trade. If you make this adjustment, you add on additional risk because you're going to be short a put spread in the SPX heading into the Wednesday report. Now, when I'm doing this, my valuation is 100% on what this net credit is. If this net credit gets down, let's say we paid $3 for the butterfly. Okay, if we executed that at $3, if this was trading for $4, that's when I would look to do the roll. That it's trading for 8 right now. The market goes against me. I could do it for 4. That's when I would look to do the roll. I am going to add $1,500 worth of risk to my trade, and I'm going to be bringing in $1, hoping that the market stays above the 45.95 level. Now, the market is going that way if we're doing it, so you have the upside momentum. The adjustment would normally be on Thursday, right? Maybe midday or whatever, based off of where the market was at. And that's how you would look at doing that adjustment. Now, it's a risky trade because we're using very short-term options. That adds to the risk a little bit. But with this trade, that's the way that I would approach it, and that's how I would handle it going into Wednesday. We'll look at it. I'll look at the market on Tuesday. And if I see an alert, and we're 55.10, we're going to make note of this. But if I see an alert going off, and then I will go and look at what the adjustment is, and then we'll talk about it on Wednesday's show. So that's it for the SPX trade that we're going to look at. Now let's go look at PayPal. On PayPal, we have the market down a little bit today, and they're going to be announcing on the open tomorrow. I'm going to go out a little bit in time. We're going to go out to the 18 days to the May 16th expiration, because I want to sell a put spread in PayPal. Now, if I look at the chart of PayPal, and let's pull this over just to get it in the center of the screen, and we'll go down a little bit. We had a very good resistance or support down here at the bottom of the chart, and made a strong bounce. We got a solid momentum to the upside, a little bit of chop within here, but we're at a precipice. If we can get a solid earnings report, we broke above the 20-day, the 50-day is just above, and then the 200-day, we're quite a ways away. That's not really in play. But to break up above this 68 level, it gives us some bullish upside momentum. So because of that trade and that potential there, I don't mind buying an out of the money put spread. We're going to look at buying we're going to pay a little bit for it. We don't want to pay a lot of dollars for this because it is a risky trade around earnings. But if we can break through this level, I think that you have very solid upside. Got a little bit of stop at 70, but all the way up towards that 200-day moving average, I think we're fairly strong at. So we're going to do a fairly tight, fairly risque, out of the money, long call spread. I'm sorry, not put. I kept saying put spread. Out of the money long call spread on PayPal. Hopefully getting some decent news after the earnings report. Seen some strong momentum. The stock really got beaten up, and I've always kind of been surprised how hard it got hit. A lot more competition came in, but this is ugly. This is like a ski hill here on the way down, all the way back up. And now we're looking to try to build some momentum again. I'm kind of looking for the dead cat bounce a little bit, breaking through that resistance level of the upside, using the earnings as a catalyst. Let's hope that happens. All right. So in this scenario, you have the strike is 65. If we look at the expected move, you're talking about $5.20. So let's pull that up. Let's just do it that way. Let's start by doing that. Okay, let's get rid of this trade. We're going to buy the 65 and buy this. Midpoint is $5.30. So if you do that math, we're saying that the marketplace is saying that 70 is in play. 68 is kind of the level that we really want to break through in order to get there. Expected move is saying that 70 is where that is at. We'll go down. We'll buy the 67. We'll buy the 67. We're going to go 18 days out. We're going to buy the 67 strike call, saying that we think the market could at least or the marketplace is saying we could at least get that based off of the expected move after earnings. We're going to buy that one. And then we're going to go out. 70 was the expected move. We'll sell something just beyond that. And this would be 4 points. I think I want to go 5 points. Let's go up to the 72 level. I don't mind that on the breakout. So let's hit the bid here. All right. So we're paying $3 on this trade. You have the 67. This would be a debit. That's not right. Buy. There we go. $1.47 to make a potential $5. So if we send this to the what if calculator. Now I don't want to go heavy on this. If we're buying an out of the money spread, you want the market to at least get to your strike. You're hoping that if you ride this to expiration, we're going to go out 18 days. I think that's what the number was. And you need the market to at least get to 68.5. That $1.50 that you're paying, it's $1.46, round up to $1.50, plus the strike price is where you need the market to get to if you're going to ride it all the way to expiration. So if you don't think that we're going to be bullish on this trade, this isn't the position for this. We're looking to get some upside momentum. We're hoping we can break the earnings, could be the catalyst that could break it through that 68 level. And that's what we're looking to do. But if we do get to 68, we're sitting okay because we're close to the break even. We're just going to have to trade the position a little bit more. All right. So that's the official paper trade. I'm going to put it down. This would be the paper trade heading into earnings. And then let's move out. Let's go full screen here for a second, if we will. And see, if you have any questions, please do put them in the chat box. Happy to address them during the show at any point in time. So let's go back and review the two trades, and then we'll call it a day. We have big earnings at the end of the week. A lot of the Mag 7 are going to be announcing. We're going to be looking at some earnings trade on Wednesday for sure. We have extremely interesting earnings, and that we have Amazon and Apple announcing on a Thursday going into a Friday. Tomorrow we have PayPal. We should get some good news or some general news about the consumers, along with some of the economic data that is coming out this week. In PayPal, we're going to be buying the 67 strike call and selling the 52 strike call with the May 16th expiration. In the SPX, we're going to look to go to a Wednesday expiration, and we're trying to buy something 5 points out of the money. We're going to go 20 points wide on our long put spread and 15 points wide or on our short put spread, making it an open wing butterfly, which is a term that I use. That's where I think it's an open wing, and giving us some downside upside if the market were to blow through our strikes, and that will expire this Wednesday. And those are going to be the two trades we're going to be watching. Tune back in on Wednesday, 11 o'clock Eastern time for the next edition of Options Guide TV inside the Tradier Hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.